Hello everyone. Another day, another chapter of our decoding market. So today we will be talking about
Your
the
voice has started
market.
to crack for some reason.
Sorry, sorry, sir.
For some reason, your voice started to crack. Now it is okay, I think.
Sorry. There might be some technical glitch, sir.
Now it's
That's
okay.
the reason.
Go on.
Yeah. So today we are going to decode the market in such a way, like most people think the market is about timing, trends, or luck. But what if we are asking wrong questions all along, right? So today our guest is someone who has built not just one but two platforms, that is Indiacharts and Strike.money, that decodes market structure in a way that most retail traders never see. Okay. So today we are keeping it very simple by asking brutal three simple questions. Okay. So hello sir
Hey,
and welcome to today's episode of Decoding Market.
pleasure.
So let's start with the first question, sir. Okay. So, what I believe that retail investors often chase price, not structure. From your lens, what is the one thing that they are missing about and how market really move?
Yeah, that's very interesting because there's this fallacy which now a lot of people slowly learn over time is that don't buy breakouts. Don't buy after the buy signal is already known, because by that time everybody knows what is going on and what is happening, which is why we encourage people to understand the trade setup, and we also encourage people to either learn Elliott wave analysis. So they have a choice. If you want to be ahead of the curve, you either understand the trade setup in which markets move, so that you can anticipate it early. You develop the RMI indicator so that you can get a buy signal faster than the MACD, and then eventually wave analysis, which tries to pick turning points ahead of everything else. Now, if you have not spent time learning Elliott wave analysis, I would push people to join the mentorship programs next batch from September. But having said that, the trade setups and sentiment basically are what keep us ahead of market turns. They also sometimes warn us that we may be on the wrong side. So let's just take the example of the last few days. The market was looking like it should fall. It fell for a few days to 24,000, just below 24,500, and then started to bounce back. Looked like a counter trend bounce. Even we thought it will fall lower. And then 3 days into last week, we had an extremely oversold reading on one of the diffusion indicators. And that started to warn us that we could be wrong. So it requires some very hard thinking, but because at the same time you have a war going on, and we are trying to figure out that technically, is there a sign that the market can go up? Now this has happened twice in the last 2 months. The first time it happened is when India and Pakistan were on conflict, and the market fell to the 20 DMA, and on that day the reading reached a very very low level. So I'm just going to show the chart so that people get an idea of what I'm really talking about.
Sure, sir.
My strike is not open or what? It doesn't. The window doesn't pick up. Okay, picked up now. Okay, so you can see my strike screen, and so this is the day. This is the day on which the market had fallen back to the 20-day average. It could have broken that and gone lower, but simultaneously, what we ended up seeing at the bottom end, this is taking a while to load. I'm just going to refresh it. Sometimes refreshing just speeds up the. I'm clear now. You can hear me.
Yeah, yes, sir. You are clear.
Okay, so it's not my internet. That is what I'm trying to make out. It's taking longer than usual. Uh, okay, I'm gonna then gonna try see if it comes on my Windows panel, because maybe it is just misbehaving on the yeah, it did. So it was just misbehaving on I use the app version. Okay, let me just share my screen again. 1 second. Okay, so yeah, here when we are looking, so at this on this particular day, in fact, the day before that, the swing fell to 6. So when it falls to 6, that is only 6% of stocks are showing positive momentum, a very oversold reading. And the next day, while the market was falling to the 20-day average, the swing actually turned up to 15. So that was a positive divergence, and that ended up, giving a signal that it may be turning around. Now, recently, when we got the bounce, we had a reading of 12. So that was also a sign of a bottom, but we were thinking, okay, it'll bounce and it will fall again. It did fall, but not much. And on that day, what we end up seeing is a completely different indicator here, which looks at the percentage of stocks that are in a bullish mode on our proprietary RMI indicator. And when we do this for the total market, we see that recently here it has actually fallen all the way down to 15. And the last time it had fallen to that level was actually here during the previous India Park thing on 9th of May. So it had fallen to around 16, and now it has fallen here to 15. In fact, on the small cap index, it even fell to a reading of 9 day before. So when you see this kind of an extreme, which means the broad market has actually sold off and already seen a correction, but the main market is not really reflecting it. So this was sort of, so this is where different setups can forewarn you. So we don't really have to wait for the breakout above 25,300 to know that which way things are going to be heading. And the only time something like this would not work is, yes, if you're in free fall like you were in COVID, then the extreme oversold conditions might not give you a complete reversal, maybe just a pause, maybe just it halts for a day or two and then again falls. So that is a different type of situation. Here it doesn't look like that is the case, and so these readings are what we will be looking at playing out in the coming days. So that is the main point, that when we pay attention to, now these are just some parts of the trade setup. There are a couple of others. For example, you had the 40 50-day moving averages near the 24 480 range, and that also ended up holding, and uh, did not give any breakdown. So somewhere you have to flip the switch. That is the tough part for everyone, that if you have a view, some people will say, what is the point? You need to stick to it, or wave analysis should certainly give you this is not about certainty. This is all about probability and being able to change. Even wave counts change, you sometimes have alternates, and we have to make that choice, and that choice of which is the preferred wave count is something that we have to make based on sentiment and the trade setup. So that is why we pay so much attention to it.
Yes, sir. So moving forward, talking of the wars, like you just talk about the wars. So given that the US has now officially joined Israel's strikes against Iran, right?
Yeah.
Including bombing the nuclear sites and closing on a decision to escalate. Okay. So what do you see in the single, like what do you see as the single biggest signal that needs to be like the global markets or for the retail investors? That signal is very, very important. And how should you like how should they respond in real time to those signals? What's your view
Yeah.
on this?
Yeah, so it's very easy to get persuaded that this war is going to escalate and things are going to go out of control. It's
Right.
always possible, and everybody is trying to weigh. And if you try to listen to some news, it will sound all bad, And then if you listen to what the US is saying, and other watchers who are like, Iran has been pulled down for various things. They may not appear as strong as they are, and the US is going to use its pressure point. Now, it's not going to be easy. Nothing is ever easy. But who has the upper hand? So finally, since you can't know all the dynamics, you hear some and you hear both sides of the story right now. One which says that they'll get it under control, and now that US has stepped in, it will end faster, which can also be true. It was proven in the Gulf War of 1990. That time fear was even higher. A lot of Indians sat in planes and came back to India. The market was suppressed for 3 months, but we saw that even though they are suppressed for 3 months, the fight ended within no period of time. They had bombed the region, entered and taken down Saddam Hussein in almost days. So that is what Donald Trump speaks of, that if we have to do something, we would, but they're still trying to negotiate that we've done so much now, you better take a step back and get back on the talking table. We don't want to go further unless you don't listen. That is the kind of approach they are taking. Now, in the end, so as individuals, how do we really take this? Which side is true? Which side is real? And the answer is the market always knows. So we have to look for the signal in the market. Say, for example, this escalation was expected to become super bad. US futures, which were negative in the morning, would not have been positive in the evening before the market close. But more important than just looking at the equity side, which is one part of the equation, because we did see a European sell-off, when all this was happening last month, in fact, last 10 days. But that's also because that market had run up the most to an all-time high as well. So a correction was due. Same, there was a correction due in our market, and we did get a small correction. But how much should we put weight on the war front? So the eventual answer has brought us to the indicator, which is oil. Because after all this is about oil. And oil prices were even rising before the attacks of Israel into Iran, which means somebody bought the oil price action. And even when OPEC was announcing increases in production, oil prices were going up, indicating that something else is at play. And then eventually it went to 78. Now, $78 is where you have this major resistance. So once again, I'm going to just share my screen and chart on the oil front. Okay, so when we look at the oil chart, there are a couple of trend lines. I'm going to remove all these bands and averages just to show you a blank chart. So a couple of trend lines. One I can take is from the 52-week high, or not more than that, 2-3-year high, which happened during the Russia crisis, almost at $130. And the next top is more recent here, that we have made around $80. And then there's one interim one here at 85. So I'm drawing two trend lines, one from this major top to this one, and one from this recent top to this one. And these trend lines are all in this congestion zone over here between $75 and $78. So now what we are really watching out for is, if this is only a counter trend move, then it will fail to cross this 75-78 range. It failed the first time. There's been a re-escalation, and again it has failed today. So although it opened at 78, currently it is trading at 74.40. So unless we get past this, I think risk levels are not elevated yet. Okay, this is how I am thinking about it. In fact, it looks like this bounce I've marked as A, B, and C has usually 5 waves, and we are in the 5th. So any trend reversal from here would mark the end of C, which means you would end up saying C is over. And once C is over, then we will start looking for oil prices to go back to $60. So this is what I'm closely watching, because the only time geopolitics will escalate, then, and it could have this morning, right? Iran has said we'll shut the Strait of Hormuz. Then why isn't it above 78? I actually thought it would be. In the morning, the first thing I wanted to check, are we cross 78? Is the Nifty going to gap down 200 points? And the answer was no. And moment the answer is no, that means any sell-off in the market gets bought into. Because the markets don't believe this is going further. And if somebody did, and somebody knew, smarter than us, they would have taken that bet. That's how you think about it. So if there's no big bet on this breaking out, then why should we take that bet? We are not going to act as the smartest people in the room. So that's the simple way of thinking about it today. Even if you don't know anything about it, and just watch oil, which is the central factor at play when anything happens in the southeast region, then that tells us everything. I mean, what more do you want to know?
Right. Sir. Got it. So then now coming to the next part, stating of the smartest people, that is the Gen Z, that is going right now. Okay, so the people who are born after 2000 or something like. So take an example of a 25 years old boy who has just started his job and all and wants to invest, right? He has a capital of 1 lakh, and if he comes to you, like what is the one market principle that you will drill into them before they place a single trade?
So learn a little bit of basic portfolio construction. I'll tell you, it is not an advanced research. You don't need a degree. You can just plan that I will own 15 to 20 stocks in my portfolio. Each stock will sort of have an equal weight. I tried and tested this with one of my Gen Z cousins who's like in his late 20s, 30s. He was, planning to buy a house, car, whatever, and he's saving. He's in the IT sector, and whatever amount he's saving every month is good was to go into the market. So we planned it accordingly that if you have so much money every month, whether it's a small amount, and this is not exactly what is his amount, but just to give an example, if it's 50,000 or 1 lakh rupees every month you're allocating, you'd sort of allocate to stocks where you expect, which are in the limelight, which are in growth phases, right? Or which are the sector plays of the moment. And you keep allocating equally, to some of them. Now, some will become very good performers, some will underperform, and you can always increase the weightage of those which are lagging behind, because what happens over time, your portfolio weights start shifting based on something which is going up more versus something which has not gone up more. So you keep doing that over time and you will achieve a good rate of return by building a portfolio. And limit yourself that, okay, I'm not going to invest in more than 20 stocks. So initially if you're only investing 50,000, you might only buy 2 or 3 stocks, 20,000 each. But eventually, when you'll buy more and more, that 20 will become 40, and so on. So two things which will happen. One is you will increase the number of stocks, and second is you might increase the amount that you're putting in each stock. You might buy the same stocks again, like a SIP in the following month. But if you're doing that, then just make sure that you're buying it equally such that the weightages remain same. It's not that you end up investing more in one and less in the other. So that sort of, so keep on balancing it. If you have it on an Excel sheet, or even if you have a portfolio, in most broker accounts you'll have a portfolio table kind of thing, automated portfolio from the DP account, which you can see, so you can know the values, the value of all your holdings, and you can keep adjusting each month. That if you have 3 stocks and one is invested 40,000, next is 40, next is 30, next is 20, I got another 50k to invest, what will I do? So jo 20 first increase the ones which are at 20 and 30,000 to bring it at par with the others, that kind of a thing. Or if you have a new stock to add to the portfolio, you add another 40, so it's equal to the rest, and this way you will keep on adding every month. Eventually end up building a portfolio of
Compounding is, right?
Yeah. And you're adding to the winners in your portfolio. And also you can have a mental stop loss that if something falls by 10, 15 or 20%, you'll probably just close it out. So that adds a level of active management, to the stocks. Esaniki, it is falling down 50% and you're still holding for the long term. So this kind of an active management and SIP into direct equity is what I believe, because I know now some people may say we don't have time for direct equity, but it's not so difficult, is what I'm saying. Which are the top stocks of the time which are performing. You can actually do that with a simple strike heat map also. If you simply choose, say for example, I simply go to the strike heat maps and only choose main indices. Okay, so we have all the key indices here, which makes it very, very easy that I can pick stocks only from key indices. I don't necessarily have to pick every sector. So if you see the winning sector of the time and then stocks within that sector, and you pick the top 2 or 3, you can sort of start building a portfolio around that. But look at performance not for one day. This is today. So when you're building a portfolio, ideally you should look for stocks with a performance of 3 months, 6 months, or 1 year, slightly longer period. And then based on that, so if I take 1 year, you'll have a very, very different picture. You see financial services doing better, healthcare. Suddenly the sectors have changed. And then within that, you'll try and find what you should ideally hold. There are a lot of stocks. You can't hold everything. Okay. So some level of technical scanning can be done. So little bit of learning, if you do, you can easily use these tools to find stocks for yourself. Or if you read well, look at recommendations from key people. Follow some services. You can get recommended stocks that other people who are providing good services tell you. But notice in my entire talk, I'm talking about picking direct stocks. Okay, I'm not talking about mutual funds and so on. I know that is another route. If you really, really don't have time, you're like a 18-hour work day. And this is not a work day thing also. If you're an investor, you have to do it on the weekends. I used to sit only once a weekend, once a month on this with my wife's cousin, not even mine. So I used to sit once a month, 1 week a month. Now, if you can't put that much time also to direct equity, then you go for mutual fund. I'm
That is the
sure
bare minimum time.
even if you're working 5 days a week in 10 hours a day, on the weekend you can find 1 hour. It will not take you more than 1.5 hour once you learn to use the tools to find stocks that you should invest in, especially when this is a bull market. So in a bull market, you just look for what is performing. Try not to buy at the highest price. So ideally you buy whenever there's a correction, and then once you've bought, you keep adding to those which are winning and getting rid of those which are not, and that sort of automatically cleans things up, and you build a portfolio. And that portfolio, then, I mean, I know a lot of people, individual investors, who've done this over time. I have friends who have done this on their own without strike also, and over the years, and their portfolio is growing like to crazy levels. So but why I advocate direct equity is the returns are always higher in a focused 15-20 stock group. But if you still feel that no, I should let somebody else do it, then choose a appropriate service of someone who would do it. A portfolio management service would always give you a higher risk, high return than a mutual fund. So again, that is a choice that you want to go with slightly higher risk. Study the performance of mutual funds and choose. Portfolio management services and choose. The last one is, of course, going for mutual funds themselves. There are a lot of funds that don't perform or give average performances. So you have to do a little bit of research on the historical performance between funds as well. But there are enough websites out there. For PMSs, there's a PMS Bazaar, and for mutual funds also there are many others. So anyway, you'll have to go back and do the same kind of data crunching in terms of what is performing over what period of time, and who's done how well through the ups and downs, and then choose accordingly.
So, but in my concern, like being in the early age and getting into the market, I think so. Taking equities is a better option than mutual funds because at this point of time, a person who is at the early 20s or the mid 20s can take a risk and can like go a further step. This further step and taking risk, I think so, might get them a head start in their life to building
Surely,
a
but you have to devote that time, that once a
right.
month, 1 hour of study, you'll have to devote to picking the right stocks. That is the main thing. I mean, all the tools to do that we have included in Strike, right? Whether it's the Strike valuation charts, which are for long-term investors, it's not for short-term investors. I mean, there are tools for every person of every time frame. But are you going to spend time on looking at valuation charts and finding stocks that are at the bottom end of their long-term cycle and turning up? And if you're willing to do that work once a month, an hour or two on the weekend, then yes, why shouldn't you do direct equity? It will definitely give you far higher returns than the other two. And at that age, as you said, take the risk and do it. But you have to be willing to put in that much at least time. You can't do direct equity without putting in some of your own time.
Right, sir. Thank you, sir. That's all for today. That's a wrap up. So
Yeah.
let's move towards the subscribers. Let's see what are they saying. So the first question is from Rahul.
I've already answered the geopolitical question, I think, in the second question of yours. So we spent a lot of time, Rahul. I think you joined in late. You should just listen to the recording once it goes live. So let's go to another question.
Yes, sir. So next one is from Iki.
No, it's not wise to always try to pick lower. In fact, some people say, "Oh, 3,000 wala stock hai, it is too expensive." 3,000 rupees has nothing to do with expensive and cheap. It used to once upon a time when the lot sizes were there. So, a 3,000 rupee stock used to have a lot size of 100, which means you had to buy 100 shares. I'm talking pre 1997 or something. Okay. Those days are gone. Now, every stock you can buy one share. So, you can buy a one share of 3,000 rupees stock also, and you can buy 100 shares of a 10 rupee stock also for 3,000 rupees. So, first of all, price should be out of the mind. The second one is he's saying, sectors which are not moving will be cheaper. Now, that's not always true. It can be true if you're catching the cycle right. Say, for example, financial sector was underperforming for the last 2.5 years. At any point of time, you could have said, this is the sector not working and I should buy it. And you would have missed out on the move in all the other sectors. The right time to move in was only when the monthly or quarterly momentum indicators started to turn bullish, probably sometime late last year or early this year. So you have to time it, and that's what the strike valuation setup on the strike platform does, is gives you the valuation charts with our RMI indicator so that you can see the long term momentum also turning along with valuation. It's not just you buy something because it's down, but you buy it when it starts performing. So you can play the rotation game, but that which is performing today, okay, when others are not, is where the returns are. And sometimes in a particular cycle, the returns continue to come in those segments for the next, 6 to 18 months. And then by simply waiting for something else to move, you will underperform the market in a big way. So that is why I don't think that's the right strategy. Without a plan of when you will get into that low lying sector, which is only when the momentum really kicks in.
So the last question is from Christopher.
What do you think of Sensex tomorrow? Well, for today, the market has closed above the 20-day average, and it did that on Friday as well. So for 2 days, we have actually saved the key support that we are watching very, very short term. So in that sense, and we have also not broken the low that we made last week, which is on the Nifty 24,733, 24,733. If that broke, it would be a very bearish setup. But till that doesn't break, it's actually a bullish setup. We've made a higher high, higher low pattern now, which is a Dow theory bullish trend outcome that's already there. And we are holding above averages. So in that sense, I think people should consider that the Sensex goes higher from here tomorrow.
So one more last question for today's session. So it's from Sanjeev
Many times I've
Sharma.
observed on higher time frame, RMI will switch from sell to buy, but on lower time frame, hourly it will indicating sell. To me, this is contradiction. Of course, there is. I mean, this is called multi-time frame analysis. Daily can be in buy, weekly can be in sell, monthly can be in buy. What should you do? So the analysis is always top down. The higher time frame always has the higher weightage. So which means that if my weekly is in buy, what would I do on the daily? I would only trade the buy signals. I'll ignore the sell signals. So because the larger trend is up and I want to trade up, then I can use the lower time frame, that is the daily, to take the buy trades. Now he's talking of hourly, which is typically for if you're doing a 1 week trade. So if your daily is in buy, you want to trade the hourly buy signals. If your daily is in sell, you want to trade the hourly sell signals, not the other way around. So that is how you do multi-time frame analysis. Why won't there be contradiction between daily and hourly? And it's amazing that I find people they find it very, very hard to digest this. Even when I write my daily report on Indiacharts on the market, and then I write one on the weekend. On the daily report, we have a trend reading which is up and down. We call the report also Nifty daily. On the weekly report, I only look at the weekly chart. Now, sometimes it happens that weekly trend is down, daily trend is up. Complete confusion. Everybody hates me, says you all don't understand anything. View kya hai, samajh mein nahi aa raha hai. they can't comprehend. So psychologically, people can't comprehend that daily and weekly can have a different opinion, because even in a rising weekly trend, you can have a 10-day correction on the daily, which is basically a 1 day, 1 week, or a 2 week pullback. It does happen, and in each time frame we have to analyze it accordingly. But people find it hard to digest because they want you to have the same view on every time frame when that is their view. If you are bullish, then the guy you're reading should be bullish on all time frames. It cannot work like that. So you choose the time frame that you want to be bullish on.
So in today's session, we are getting a single comment multiple times. So I think so people are really liking the valuation setup and the RMS setup. So it's
Thank
coming
you,
up like
Parth
more
Rathi.
and
Thank you. Yeah, thanks to
and
Parth. Thanks to Thug,
these are some,
Sandy,
yeah.
and
Okay, sir.
Genos. Yes. He's actually hacking scanner kab aayega. Yeah, GenOS actually. So the news is, what we were trying to do is we were trying to clean up our entire software code so that you don't get glitches and all, which you notice sometimes. You may have recently noticed it improving. It will further improve when the next release happens, which is anytime now. Every day we are on the final stage of testing the next release, and in that you'll get 1 minute live on everything, which is right now it's only in options. So when that happens, there'll be the first stage of things improving. The scanner is ready, but it will be in the next release, not the one which will come this week. I think after that, that's the only thing we'll be working on. I mean, it's almost ready, but it will take maybe a week or two before we release that, after we do this release, so that we see this one stabilize and then we release that. So it should be, I think, let me put a 1 month at least time frame. It could be 2 weeks, but a 1 month time frame at least to see it through.
Yeah.
So there'll be a simple scanner and an advanced. So even we are working on the advanced one where you can do, you can combine multiple things, technical, fundamental, everything. But yeah, just give us that much more time that you have been patient.
So that's a wrap up for everyone. Thank you, sir. Thank you very much today's session, and thanks everyone for joining. Let's stay tuned for the next session on Wednesday, same time. Let's catch up. Thank you. Thank
Thank
you,
you.
sir.
See you again. See you all. Thank you so much.